What type of interest rate is right for you on your mortgage? Variable or fixed? Hi, I'm Seth. I'm a realtor in Canada in the province of Ontario. This video will help you make a better choice on the rates offered by the banks on your house mortgage. Interest is a fee you pay on the borrowed funds. You buy a house, the bank pays for it, and now you are under mortgage debt. You have to pay interest on it. Now this interest rate matters a lot. The mortgage amount is usually in hundreds of thousands of dollars. So even a small percentage like 0.5% makes a huge difference in your mortgage payments. For example, you buy a house of $500,000 and there's a bank that offers you interest rate at 6% and there's a bank that offers you interest at 6.5%. You will pay around $2,000 more in 1 year to the bank that offers 6.5%. For some people, this amount is not a big deal. I hope you're one of them. But it is still something to be considered when you're shopping around for mortgages from different banks. There are two types of interest rates: fixed interest rate and variable interest rate. As the name suggests, fixed interest rate does not change while variable interest rate changes. Let's talk about fixed interest rate first. When you go to the bank, they offer you one rate for the term of the mortgage. You pay fixed monthly payments. Part of it goes to pay down the principal, part of it goes to pay down the interest. Every year you pay less interest and more principal than previous year. Every time you make a mortgage payment, the total principal amount reduces. So the interest calculated on that amount is also reduced. And you are paying fixed amount. That means portion dedicated for principal gets bigger and bigger, and portion dedicated for the interest gets smaller and smaller over the years. There are certain features in the fixed rates offered by the banks. For example, fixed rate closed, fixed rate open. In closed, you cannot pay the principal amount early if you want to before the renewal. In open, you have the option to pay down the principal before the mortgage term ends. Fixed open rates are higher than fixed close rates. There is fixed high ratio rate also. On the mortgages with down payment less than 20%, those rates are even lower. Variable rates are connected with the prime rate. The prime rate changes, and the prime rate is different than the Bank of Canada's policy rate. Each bank has its own prime rate, and all the banks' prime rates are not necessarily the same. They could be different. Prime rates are always higher than the Bank of Canada's rate, but they are dependent on Bank of Canada's rate. Whenever Bank of Canada changes the rate, the prime rates of the banks change. The variable rates offered on different products by the banks are like prime plus 1%, prime plus 2%, prime plus 3%, etc., etc. Just like fixed rates, the variable rates come with different features. For example, there is fixed payment variable rate, adjustable payment variable rate, hybrid payment variable rate. In fixed payment variable rate, your monthly mortgage payment is fixed, but the interest rate keeps changing. So sometimes you pay more towards the interest, less towards the principal. Sometimes you pay more towards the principal, less towards the interest. There is also a trigger point in the interest above which your fixed payment need to be changed. In adjustable payment variable rate, the monthly payments are not fixed. They change as the interest rate changes. A fixed amount is applied towards the principal. The rest goes to the interest. You will know in advance how much principal will be paid by the end of the mortgage term. In hybrid interest rate, part of the interest is fixed, part of the interest is variable. Fixed portion gives you some benefit when the interest rates are going up, and variable portion gives you some benefit when the interest rates are coming down. When we are talking about the benefits of these rates, one benefit of the fixed rate is there is stability in your expenses. During the term of the mortgage, which is usually 1 year, 3 year, or 5 year, your payments stay the same. Your interest rate stays the same. Every month, you know how much you will be paying for your housing costs. Every year, expenses are known to you in advance. You can do your calculation comparing your house income or your income with the expenses. Like I like to keep calculator beside me when I am at home and I'm doing my calculations every day. It just gives you a peace of mind when you know how much expenses you need to incur this year against the income you will have this year. You also know in advance how much principal would have been paid by the end of the term of the mortgage. The second benefit of fixed rate is that you are immune against the rising interest rate. This could be really beneficial during the high inflation, during central banks rate hikes, everything is getting more and more expensive, and you are able to save some money in your mortgage payments. That can make your life easier. On the downside, when your interest rates are coming down, you don't have the opportunity to take the benefit of those interest rates. You will need to wait until the renewal of your mortgage. The other disadvantage is fixed rates are always higher than variable rates, which is actually the benefit of variable rates. They are lower. You pay less interest. As I explained at the start of this video, even a small percentage of interest can be translated into thousands of dollars. So choosing for variable interest rate is always cheaper than choosing for fixed interest rate at the start of your mortgage. The other benefit of variable interest rate is when the interest rates are going down, the interest calculated on your mortgage is also lower, and you save money in your mortgage payments. The disadvantage of variable rate is that nobody can foretell how much payment would be applied towards your principal by the end of the term. You will never know how much principal you would have paid. You're also in a disadvantageous position if the interest rates are running high, inflation is running high. You can end up paying a lot of money in interest. Occasionally, when the interest rates goes really high, your monthly payment is not applied toward principal, it's only applied towards interest. And in worst case scenario, your monthly mortgage payment does not even cover the interest payment. So the extra interest is added to your principal mortgage. So instead of principal mortgage amount going down, it increases by the end of the term. When you are renewing your mortgage, the bank might ask you to pay extra money. A lot of banks offer convertibility option by which you can switch to fixed rate. This option can be used in these situations. Knowing these advantages and disadvantages will let you know what you are comfortable with. Usually the first time home buyers want to be more in control of the expenses. They're starting out their investment journey and they choose for fixed interest rates. This gives them the peace of mind and the most of the things are going according to their plan. They are not taking benefit of the changing interest rates for profits, and they don't have the tolerance to take the losses either. So fixed interest rates work best for them. If you are someone in that similar scenario, fixed interest rate might be a better option for you. The investors usually opt for variable interest rate. This allows them to reduce the carrying cost of the property, and they are more likely to sell the house after a couple of years, so they are not concerned with how much principal amount would be paid after the end of the term. If you are an investor, probably variable rate would work for you. So whatever rate you choose, make sure that your financial situation allows it and you are comfortable with it. Like and subscribe, comment if you want to. Thanks for watching.